Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How's it going today? Welcome to FinTips. This is our really short video series. I hope you'll check out the playlist on there where we just teach you something quickly and then get out of your way. And today, I'm talking to the beginners out there. Where are all the beginners that are like, I got the basic questions, man, I need help with this sort of thing. I'm going to compare ETFs to mutual funds today in a very basic way and just try to help you out. Now, we work with investors of all sizes, and I get a lot of questions from beginners. That's perfect. We love working with beginners here at Jazz Wealth. I hope you'll check us out if you get a free moment. Now, mutual funds and ETF, both of them are baskets of stocks. Now, they can include other stuff as well, but for the most part, you're looking at investing in a basket of different stocks by buying one product. You buy a mutual fund, you're buying a bunch of different stocks. They can include other stuff, of course, but let's keep it simple today. We'll talk about this. If you don't have enough money to diversify, let's say you go, Dustin, I want to buy all these different stocks, but I can't. I don't have enough money yet. I'm just getting started, or I have a smaller balance. So I really need to look at mutual funds or ETFs. Now, these are inherently diverse, meaning you can buy just one. If you find an ETF you like or a mutual fund, you can certainly just buy one because inside of them is a whole basket of stocks. Very common question I get all the time is, Dustin, I don't want to invest in stocks, right? I want to invest in this mutual fund. Well, in reality, you're investing in a mutual fund that just goes out and buys a bunch of stocks. So you may be saying, I don't want to invest in individual stocks, like I don't want to buy 3 stocks and hope for the best. I want to be diverse. And in this case, you're going to check out mutual funds. Now, or ETFs. In this case, there are 2 types of mutual funds and ETFs. There are active mutual funds and there are passive mutual funds. Now, this isn't so important unless you really want to get into some of the details here. But basically, a passive mutual fund or passive ETF, it means that there's really no human running the ship, right? They have an objective, they put something together, and then they go, that's good enough. We don't really have to do anything, so you're going to pay a little bit less there. This would be things like index funds, where they just try to mirror a particular index, maybe the S&P 500 or some international index. It could be anything. And so those would be passive funds. They tend to be a little less costly. We'll get to that in a second. And that's just because there's less humans there that need to get paid, right? They sort of set it up. You're paying for the administration fees and, things that they have to cover to keep the lights on and things like that. Active mutual funds are where there are humans. They're picking the investments. It could be an active ETF as well. And this is where they're essentially saying, this is our objective, and as we need to move stocks in and out to do whatever we need to do to keep on objective, we'll do that. So there are humans making decisions there, or they call them fund managers. Many mutual funds, in fact, most mutual funds these days are actively managed. So yeah, there's the index funds in there, but target date funds are technically actively managed, right? You could have growth stock funds. Those are actively managed as well. Now, ETFs tend to be more passive. There are still active ETFs out there, but for the most part, they're just basically passive funds that follow individual indices or sectors. So for the most part, if you're thinking you want to be a little bit more passive, you may want to compare that. I'll talk about the cost in a second. Now, both of these are going to cost you something, right? So to give you an idea, if we take a look at active versus passive mutual funds versus, we'll say these are mutual funds up here. We'll say these are ETFs over here. If you look at the cost, just the average cost, now of course you could do a lot better. An active mutual fund, average cost expense ratio is how we say that, is going to cost you about 1.1%. That's the average. And I use Morningstar for this, so I'm not just like making it up. That's the average expense ratio. And in terms of cost, that's the words that we use. We actually say it's an expense ratio that gets charged to you. Average active mutual fund, 1.1%. Average active ETF is almost half, 0.6%. So already right there you're going, all right, if I'm comfortable with ETFs, it may be something I want to look at. The average passive mutual fund is currently charging, 0.8%. So relatively cheap. You can certainly do better if you do a little bit of research in there. And the average passive ETF is charging about 0.5% to participate. Of course, I know there are much cheaper ones out there and there are much more expensive ones out there. In many cases, you can actually do a lot better if you're willing to do a little research there. Just an average to give you an idea of why you may want to compare one or the other. Now, each ETF or mutual fund has an objective. Think of it as like a business plan. You start a business and you have something you want to sell, somebody you want to sell it to, you want a desired profit margin in mind, you have expenses that you're willing to incur. That is essentially the business plan for you. For a mutual fund or an ETF, they call them objectives. You can also look at their prospectus, which is just a fancy way of saying it's a bunch of paperwork that lets you know what they're about to do, what it costs, how they will operate going forward. Our funds on our website, they're expense-free, by the way. We don't charge any of our customers for our funds that we build. But if you go to our website and click on portfolios at the top, we tried to take all the garbage out that these mutual funds put in to sort of confuse you and bore you to death. And we just put in there, this is the objective. This is what it is, and this is how we will manage this fund going forward. So you know exactly, what we're trying to do there. Now, if we take a look at active mutual funds, it means that, like I said a minute ago, they can make decisions. You could have a fund manager who believes that the market or whatever they're following is about to get weak or is about to get strong. So they can make decisions in there. They can actually make major adjustments. Target date funds would be a great example. Target date funds, they were moving more money into stocks up until like last year because that's where all the action was. Now that bonds are starting to pay a little bit more or yield a little bit more, you're starting to see them move some money back into that category, okay? So a fund manager in a mutual fund, he can make decisions in an active fund. If he makes good decisions, you stick with him. If he makes bad decisions, well, he could lose his job, right? So there is the chance that you have a poor fund manager out there. They're all tracked, by the way. You can follow all of them and see how well or poorly they do. For ETFs, they're mostly passive, so you're basically just along for the ride. You read through the objective, you go, hey, what do you guys do? You're following the Russell 2000? Okay, I'd like to go along for that ride. It helps you diversify. You got 2,000 plus stocks you can invest in, and there's really not going to be much change, right? Now, the final thing that I want to talk about is how they're traded, okay? So, meaning how you buy and sell them. Mutual funds, you can only buy after the markets close, buy or sell. Right? So the markets go through the whole day. You can't do anything. You can't get in. You can't get out. You can place your order, but it won't go through until the end of the day. And mutual funds, you have to buy from the company that offers them. You actually can't trade them on the open market. So I couldn't buy it from you. You couldn't sell it to me, etc. ETFs trade just like stocks. You could buy a share of Apple at 10 o'clock in the morning. You could change your mind and sell it at 1. So at any point, you can buy or sell an ETF. And a lot of times, even when the market's closed, you could still buy and sell ETFs. Now, I know that for a lot of long-term investors, you don't really care, right? You're not going to buy something in the morning and sell it in the afternoon. But hey, how many times have you woken up and seen the markets trading lower and you go, I'd like to be a part of that, only to find that by the end of the day, the markets were positive again? There could be those little moments in time, if you're really into it, that you want to play around a little bit. It's always discouraged, but hey, we're humans. We like to see a discount in the markets, right? Anything you like to see fall a little bit so you can buy cheaper. Well, anyways, that's just a quick overview of mutual funds versus ETFs. Very basic there. I hope it helps you in some way. If so, maybe you'll hit the subscribe button. That always helps us out in some way I haven't figured out yet. Otherwise, check us out at jazzwealth.com. I appreciate you watching, and have a great rest of your day.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.